Hi, this is Sean Lee from Unwavering Capital, and I am here to talk about DaVita stock after reporting its Q2 25 earnings. Despite beating Q2 25 earnings expectations and demonstrating lower than feared patient care cost, the DaVita stock price has plummeted by 26% in the past 6 months. The drop is primarily due to the risk I correctly anticipated in my previous write up but failed to fully capture its magnitude. Negative 2025 US patient treatment volume growth, led by a high mortality rate and high missed treatment rate, both due to flu season. However, while the nearsighted market is focused on lower guidance due on the negative patient outflow for second half 2025, we should be more attentive to the forecast by DaVita and Fresenius of 2% plus US volume growth between 26 and 2035. This is especially true as the CDC recently reported that flu season has largely wound down. The thesis that medical innovations will be a net tailwind to long term treatment volumes due to reduced mortality is still intact. In my previous write ups, I highlighted how medications like GLP-1 will reduce cardiovascular mortality since 6 times more CKD patients die of cardiovascular disease than progress to kidney replacement therapy. This will create a larger population that could potentially be incident on ESRD, offsetting some of the impact of incident delay. Recently, there have been more overlooked evidence that suggests higher dialysis patients are viable and fewer mistreatments in the future. For instance, DaVita expects to deploy an FDA-cleared hemodiafiltration machine 5009X in 2026. According to the Convince study, patients who received just 3 months of treatment from this machine resulted in 4.4% fewer deaths over 2.5 years of follow-up. Other real world evidence shows that this new therapy option also comes along with reduced hospitalization rates as well as improved quality of life and outcomes per patients, which is expected to reduce the number of missed treatments. Indeed, it may take more than 5 years to achieve a meaningful impact on results due to the time required for independent nephrologists to adopt new technology combined with manufacturing capacity. But since the bear's thesis hinges on DaVita's low terminal value due to lower ESRD incidence and slow progression from late stage CKD to ESRD with higher penetration of GLP-1, these innovations help me build conviction that the 2 plus long-term US volume growth is feasible, and investors will eventually re-rate DaVita stock once we gradually see the financial benefits from these technologies. Investors have penalized DaVita for the cyber attack too harshly. While DaVita stock plunged by 26% in the past 6 months, Fresenius share only fell by 0.4% because of the differences in their 2025 volume guidance. Whereas Fresenius expects it to be flat or slightly positive, DaVita forecasts year-over-year decline of 75 to 100 basis points. We can therefore deduce that bears are pricing in April ransomware, the key driver of DaVita's negative outlook, as an idiosyncratic risk. However, I believe that the incident shouldn't be an indication of large cybersecurity investment required in the future, as DaVita management confirmed. Also, DaVita should not be regarded as a weaker operator because Fresenius has struggled with cyber attacks in the past as well. Instead, it should be regarded as a systematic risk, resulting in a one-time $55 million EBIT hit and 550 fewer patients amidst this quarter. We should eventually see similar volume guidance from the duopolies for 2026 and beyond once the impact of the cyber incident is behind us. Moreover, investors should be mindful of $13 million to $83 million in insurance recoveries from the cyber attack that will be received in the next 12 months. Berkshire's stock sale is not a sign that Warren Buffett no longer believes in its upside, and misinformation will likely lead some to sell DaVita. The dialysis company agreed to buy back stock from Berkshire when the ownership by Buffett's firm topped 45%. I attribute the motivations behind the move to the fact that Berkshire doesn't want to trigger extra scrutiny from regulators and creditors by owning a politically sensitive healthcare provider. Moreover, Berkshire probably doesn't want to report DaVita's heavy debt load on its balance sheet by becoming a controlling shareholder. The key reason why I have a strong conviction about this is because Berkshire investment manager Ted Weschler hasn't personally sold any DaVita shares and still maintains a 3.1% ownership. Barron's August 5th, 2025 article erroneously reported that Berkshire has reduced its DaVita stake to 42% when Capital IQ notes that Berkshire has only trimmed its holdings to 44.98%. I suspect that due to the incorrect news, some of the Buffett's followers may have misinterpreted Berkshire's routine sale as the start of major sales and sold their DaVita stocks as well. I believe investors shouldn't misread Berkshire's moves and instead focus on DaVita's recurring and stable free cash flow generation and accretive share buybacks. The risk is that the mortality rate may remain elevated in the short term due to the resurgence of COVID. As of August 5th, 2025, the CDC reported that COVID infections are growing in 45 states as children begin returning to school and as officials plan to restrict booster shots. While cases are increasingly less quickly than at the start of other surges, it is too soon to tell how big the current late summer wave could get. And with highly varied immune responses from prior infections and vaccinations, it is difficult to know how severe illness could be. To account for the possibility of elevated death rates and mistreatments among dialysis patients, I've modeled a 1.3 negative volume growth for the next 12 months in my bear scenario. Moving on to the valuation. I applied a 6.5 times forward cash flow per share multiple in my base scenario to obtain my price target. This is a conservative estimate because 6.5 times is DaVita's 5-year historical average multiple, and adjusted cash flow per share is obtained by subtracting share-based compensation from free cash flow. I believe the market will grant DaVita this premium within the next year once it guides strong revenue guidance that offsets the continued weakness in the short-term U.S. treatment volume. DaVita has many levers to do so. For instance, DaVita has been using AI for dosing of certain drugs, which is in full swing, and is in the final stages of using AI to gather clinical information and to be used for ambient listening. The company also utilizes AI in call centers for outbound calls related to prior authorization and for claims processing. We should see positive ROI on DaVita's results from these initiatives in the next year. I also built a DCF model and public comps analysis as sanity checks. I used 6.5 times next to 12 months EBITDA to obtain my terminal value. This, once again, is a conservative estimate because DaVita's current next 2 months EBITDA is 8.3 times. Bears may question DaVita's premium over its biggest competitor, Fresenius. However, I will point out that DaVita's revenue growth of 5.6% is higher and that DaVita's EBITDA margin of 27% is also higher. Furthermore, DaVita's free cash flow is more recurring, stable, and predictable as a pure dialysis provider. Thank you for watching.